This is the Biz News Podcast, one-on-one conversations with experts in business and personal development.
Steve Selengut carries some secrets that he's eager to share. Mr. Selengut manages investment portfolios and has written a book to help investors in their efforts for a financially firm retirement. He is our guest in this episode of Bizgnus Interviews. Steve, you have advised thousands of people over the years about financial affairs, especially getting them ready for retirement. But what age should people be considering putting money aside for retirement? When they're right out of school, just starting a family, somewhere down the road from there, or when?
Well, I kind of started as soon as I started developing an investment portfolio. I put some of my money away for income, mainly because my dad, who was a real estate developer and builder and so on, always pointed out that it was the income you got from your investments that really made them worthwhile, not necessarily how they blew up in market value. So he had income coming from rents. He had income coming from mortgages that he would take the mortgages back on some of the houses he sold. He and his attorney started a lumberyard so that he and all the contractors he used would be getting all their materials for building. So he had a vertically integrated. I learned in my economics course in college that was called vertical integration. And that's what he had as a business. So
Sounds
one of
like
the things he
really
taught me then was
he really had it nailed down, apparently.
Oh, he sure did. And the income came from several different sources. So if it was a year that you couldn't sell homes, you were still getting your rentals. You know, you were still getting the proceeds from the insurance. You were still getting the proceeds from the mortgages. You were still getting the whatever the lumberyard was producing. So when I first started investing, I said I'm not going to invest in anything that doesn't pay me some income. And I'm going to start growing, and I'm going to grow my income. I'm going to try to grow my income all the time, so I have excess income. And that's how I got started with the income. I encourage anybody who in my career, I had a lot of people who weren't anywhere near retirement age yet, but I never built a portfolio that was totally stock market. Every portfolio had at least 30% invested for income. And the way I analyzed things, I based it on what I call working capital instead of market value. Every dollar of income, every dollar of profits, 30 cents of that went into income production. So as the guy developed and got a career and so forth, and then of course the hiatus when they have to spend for their kids' educations, and they can't put any more in, but at least what they had was paying them some income. Yeah, getting ready for retirement, you got to start thinking about it in your 50s. If you haven't already prepared income, you got to start thinking about it in your early 50s to get there.
Oddly enough, Steve, that's a lot later than I would have thought you would have said. I would have expected you to start thinking about that shortly after you left the cradle.
Well, for me, that's the way it was. I was pretty fortunate growing up. Most young people hardly have the capability of staying out of debt today, much less of developing an income portfolio. So once they get out of college and they get their first job, and maybe they get a nice job where they're getting some big bonuses at the end of the year, instead of building a swimming pool, put some of it away. So it all depends on the individual situation. But for the most part, once you start investing, 30% at least for income, and you'll get there.
And how do you identify what to put that 30% into?
Okay. You have to understand the difference of different securities in investing, particularly in the corporate world where you have stocks and bonds. Stocks are ownership of a corporation. Bonds are the debt of that same corporation. Debt securities, in case of emergency, debt securities are paid off first, and stockholders rarely get anything at all. So that's income securities, those and government securities like state municipal bonds and government T-bills and notes and so forth are income purpose securities. Mortgages are income purpose securities, preferred stocks, um, and then there are a number of other hybrid types of securities. I use what are called pass-through trusts, closed-end funds. Closed-end funds are the oldest form of fund in the markets. Way before, 30 years before mutual funds, over 100 years before ETFs, there were closed-end funds. And these are pass-through trusts, just like you and I would put aside for our grandchildren, the money go to them, a trustee would take care of it. These are pass-through trusts, and the income that the managers of these trusts make, 95% of it has to go to the shareholders. Now, wouldn't that be nice if that were true of Amazon or Microsoft, huh?
Why the
Could you imagine?
shareholders would be dancing in the streets.
Absolutely, but unfortunately, that's not the case. But with closed-end funds, the purpose is to produce income for the shareholders, not to grow the market value or the price of the security itself. So it's a whole different mindset. If you're going to invest for income, these things right now, believe it or not, the ones that are mainly income purpose securities inside are paying over 9%. The ones that are in the stock market are paying close to 9%. And that's annual income, of course. So, so you have to get the mindset that I'm interested in the income. And over the years, if I can make this kind of an income every year, I am going to beat the markets, but more importantly, I'm going to be able to grow my income every year as well and still have a presence in the stock market. I I don't own one common stock anymore. When I first started, of course, I did, but now it's all my stock market investing is through closed-end funds. I own every stock you could imagine. The ones I'm in, they own that Amazon, they own Nvidia, they own everything in every sector. But I don't have that risk associated with it because I've got a portfolio of hundreds and hundreds of stocks instead of the position in just one. So that's the difference.
So you don't have to worry about what Elon Musk is doing with its Tesla manufacturing or whatever.
Exactly. I don't think Tesla has earned its first dollar of profit yet. I'm not sure of that, but they may have started to make some profits, but not a whole lot. Certainly not much. You
And
know, and Microsoft today, as great as it is, pays less than 1% in dividends to its shareholders. I'm not sure Amazon pays any, but most of the FANG stocks and most of the NASDAQ companies don't pay dividends at all.
when people come to you for advice, do you see a common thread that you need to deal with first before you get into specifics? And if so,
I
what is that?
That's an incredible question. I actually see several common threads. Common thread A is that there are very few income purpose securities in the portfolio. If it's a portfolio of totally mutual funds, there'll be 10 or 20% maybe, even in a retiree, but very, very few income purpose securities. B, there'll be securities that make up 10, 20, even 30% of the person's portfolio. I've seen portfolios where there was $1 million divided amongst two common stocks and one mutual fund. Crazy bad diversification. It's like diversification doesn't exist. Um, the average yield on the portfolios that I look at is less than 3%. Less than 3%. And these are the same people who tell you that when you retire, you're going to need 4% of your portfolio to spend each year. You know what I mean? Where is it coming from? They have to sell securities to pay their bills. And with less than 3%, and that's less than 3%, that's before fees. Most of these guys, even in a model portfolio, they're charging close to 1.5% or something like that. So that's the kind of things. And the another thing I see is that particularly if they're professionally managed, and there's reasons for this, there very few of them ever take their profits. They just sit on the profits. They love the securities that go up in price, and they don't take profits at all. And there's reasons for that. Um, as a professional, if you were a broker and you just said you went and sold a guy's Microsoft 5 years ago because he had doubled his money on it, the guy could still come back and sue you today because now it's at an all-time high, way higher than it was when you sold it. How come you sold my Microsoft? I'd be richer today, you know? So that's the type of thing that keeps professionals from recommending to their clients to take profits. Their bosses are afraid of lawsuits. You do not. When I was there, you know, uh, Ken would have never, my broker would have never suggested to any of my clients that they sell something to take a profit. I was managing their money, and they knew I was going to take profits because I put it in writing that my job was to take the profits. But in a normal situation, a broker is not going to encourage a client to take profits. They encourage losses because they think that's a tax benefit, but they don't encourage profits.
What a contrary way to go about life, it would seem.
My approach is contrary. I think their approach can be seen as contrary to their clients' interests. My approach is certainly contrary to the conventional wisdom on Wall Street. I set profit targets for everything I own, even these wonderful closed-end funds that I was talking about. If I can take a 5% profit, that's the equivalent of, even at 10%, that's the equivalent of 4 months dividends. And I've got it right now, and I can reinvest it at 10% in something else. So they don't think in those terms. They think of amount under management or market value under management, and that's how they get paid today.
Did
In
you,
today's world, used to be commissions, now it's fees.
Steve, as you were developing this philosophy, did you find it hard to sell that to your clients?
Oh, not at all. I mean, really not at all. I mean, people like to know, they like to sleep nights. They don't like to, look at the crash of 87. You know how many phone calls I got? I got one phone call. I was managing money for almost 100 different people. I got one phone call from my dentist. And he says, "You are buying, right?" That's what the phone call was. When they were, they knew that when prices were going down, I was buying. When prices were going up, I was selling. And there's a reason why they were comfortable with, and it's a matter of how you select the securities you buy in the first place. Even in individual stocks. Back in the day, and I don't know, you may be familiar with the Standard and Poor's guide. They had a monthly guide, and it was about yay thick. I might even have one still. This is what the S&P stock guide used to look like. This is circa 2018. I think this is the last one I got. They would list every common stock, every stock there was, and they'd give it a rating. And their rating system went to D to A plus. And in order to be as good as a B plus, you had to pay a dividend, you had to be profitable, you had to, that type of thing. So I didn't ever buy anybody a stock that wasn't rated B plus or better. I never owned a stock that didn't pay a dividend. It had to be traded on the New York Stock Exchange because originally the listing requirements were stiffer on a New York exchange than they were elsewhere. Anything you can do to minimize the risk associated with the securities you own, I put into place. Diversification, income production, and the quality level as given to me by Standard & Poor's. You can do the same thing And I explained this in my book, which I haven't mentioned. It's called
We were just
Retirement.
just getting around to that, by the way.
In that book, I talk about the four great risk minimizers in any type of investment. It's quality, diversification, income, and profit taking is actually Most people lose money on stocks that they've had originally that have gone up and gone up a lot. They hold on to them, then they start to go down. It'll come back. It'll come back. I used to say that, most of the profits you see on your statements wind up on your tax return on Schedule D. So I don't let that happen.
Tell our listeners and viewers the name of your book.
The book is called Retirement Money Secrets, and it's available at Amazon. And it's what we call it is a financial insider me guide to achieving income independence, meaning getting to the point where you have enough income that you don't so much income or enough income you don't have to worry about the ups and downs of the stock market or even the ups and downs of interest rates or even COVID. Your income is going to keep right on coming. So
And do you have a website where our listeners and viewers can get more information?
yeah, it's called theincomecoach.net. And it's, that's me, the retirement income independence coach is what I call that's my Facebook group anyway. So, yeah, so what I'm there for is to look at portfolios, to show people where they might have a little bit more risk than they really need and how they can improve the income that comes to them every month and make it grow every year.
Steve, did you leave anything out of your book that you wish you had put in?
Oh man, that's a good one. Let me think. I haven't had this question before. I think I probably could have gone into a little bit more depth into the one question of when when you start, when you asked me before, when in a person's life should they start thinking about the income production from their portfolios? Because the pressure and think about the terminology people use when they invest. They're going to make a bet. I'm betting that this one's going up. I'm going to take a chance on this. I'm going to put my money in. What's hot? You know, all these types of questions they use. Would they use those if they were, looking for who they want to go get a job from? Nah, they wouldn't say, I'm going to go to an employer who maybe someday will pay me a lot of money because I help them invent. No, they want benefits. They want security. They want safety. They want stability. They want a nice community to talk to. That's what they want. But that's not how they approach investing, which is where they really should look for stability and quality and stuff like that. That's the way I look at it anyway. So
Steve, you've covered a wide range of topics here, but what would you like to say that we haven't had a chance to talk about?
um we talked about, we really have covered quite a bit of stuff here. We talked about risk minimization with those things. We talked about uh, principles, two other principles, I think, and one of them's kind of a mindset that we touched on. The other is just reality. What is the market? What are the markets? How do they move? What do they really look like? What should your expectations be? If you were to look at a long-term view of any of the market averages and of most individual securities that have been around a long time, you'll see a pattern. You'll see a distinct pattern. You'll see them going steadily higher, the good ones that we're talking about, but they'll have a lot of fluctuation. They'll all go down in 87. They'll all go down. All the NASDAQ companies and tech companies will go down in 2000. The others, the good ones with pay dividends, will go up. Everything will go down in the Great Recession. Everything will go down during COVID. But every high quality company, with 3 or 4 exceptions during the financial crisis, will come back to establish new highs, and not in a long period of time. In the 87, it took 18 months before the crash was no longer a crash, before that opportunity wound its way out. So, there is a market cycle, just like there's an economic cycle, an interest rate cycle. The others all impact the market cycle. But the one thing that's true about the market cycle is that it has no real financial impact on you unless you take action. If the market goes up and you don't take profits, when it goes down, you're right back where you started. If the market goes down and you don't take action, it goes back up, you're right, and so on. You've got to have a system in place that says, I'm buying when prices are lower and I'm taking my profits when they go up. And you keep doing that. I'm buying less of securities when the market's near its high and more of them when the market's at its low, and so on. But I'm always taking profits and I'm always buying quality, and so on. That's the market cycle. You got to figure out, there isn't a person alive that can tell you what's going to happen tomorrow. I don't care how well respected he is. He's not going to be able to predict tomorrow's stock market, or particularly individual stock movements. Okay. So you just have to know you're in a cycle and where you are. You can easily say if you're at or near a top, and you can do the same with a bottom. If you're somewhere in between, who knows where it's going to go. But, you can always know where you are. And that's one of the things you have to learn. The other thing is the mindset issue. You've got to make yourself and your financial professional focus on the amount of income his choices or your choices are producing for you, because they are what it takes. Even if you have a huge salary in your investment portfolio, it's the reinvestment of those earnings that increase your capital and increase your potential future earnings. So you have to get to the mindset of income being king. It's more important than market value. The tagline on the very top of the book above the title says, market value fuels the ego, income fuels the yacht.
You've been listening to the Biz News Podcast. We welcome your input. Send your email to editor@bizgnus.com. That's BIZGNUS.com. Thanks for listening.